You did everything right, or at least that's what you thought. You bought gold when the world started getting unstable. You watched the geopolitical tensions rise. You followed what every expert tells you to do during uncertainty, and yet somehow your portfolio is bleeding. Your gold holdings are down, your silver's even worse, and nothing about it makes sense. Wars are ongoing, bombs are still dropping in the Middle East, central banks are buying gold at record levels, and the global debt has crossed unimaginable levels, yet instead of rising, gold is falling. So let me ask you something directly. Do you actually understand why this is happening? Not the simple explanation you hear on the news, but the real underlying mechanism. Because if you don't, there's a very high chance you're going to make the worst possible decision at the exact worst possible moment. And that mistake could cost you the most important financial opportunity of the next 5 years. Now, this isn't just a theory or a random opinion. This is a pattern, a mechanical sequence that has repeated itself again and again after every major oil shock since 1973, without a single exception. I've spent over 4 decades studying how gold and silver behave during global crises. And once you truly understand this pattern, you won't be able to ignore it. More importantly, once you understand what usually comes next, something that almost no one is talking about right now, you'll realize why this situation is far more serious and far more important than it appears on the surface. By the end of this, you will clearly see the exact chain of events that causes gold to drop during times when it should logically rise. You will understand what history shows happens after that drop across the past 50 years. And you will recognize a 4-phase recovery pattern that is played out repeatedly in every major cycle. And more importantly, you'll understand why the setup we are seeing in 2026 is not normal. It is more extreme than anything we've witnessed before, which means the next move could be larger than anything we've seen in modern financial history. So before anything else, we need to break down the mechanism, because without understanding this, nothing else will make sense. Let's start with a simple but uncomfortable question that most financial media avoids answering clearly. Why does gold fall during war? It sounds completely backwards. Gold is supposed to be the ultimate safe haven, the asset people run to when everything else is uncertain. So why is it that when a major event happens, like Iran closing the Strait of Hormuz and conflict escalating across the Middle East, gold doesn't rise immediately, but instead drops significantly? Why did it fall from over $5,400 down to nearly $4,600, despite everything going wrong globally? The answer lies in a sequence of events that is mechanical, predictable, and repeatable. Once you understand this sequence, you'll start recognizing it every time it appears. And more importantly, you won't panic when it happens again. It all starts with step 1. A geopolitical event triggers an oil shock. In this case, the Iran conflict pushed oil prices sharply higher, with Brent crude jumping from around $75 to above $112 in just a few weeks. That kind of rapid increase represents one of the most significant disruptions in energy supply seen in decades. Then comes step 2, and this is where things begin to shift in financial markets. The spike in oil doesn't immediately create inflation, but it changes expectations about inflation. And in markets, expectations often matter just as much as reality itself. The moment traders believe inflation is coming, they start pricing it in instantly, adjusting their positions based on what they expect to happen next rather than what is happening right now. Step 3 follows naturally from this shift in expectations. If inflation is expected to rise, the Federal Reserve becomes limited in what it can do. Before the oil shock, there was discussion about potential rate cuts. But once inflation expectations rise, that possibility disappears. The Fed cannot justify lowering interest rates in an environment where inflation is expected to increase, so those anticipated rate cuts get pushed further into the future, in this case, potentially beyond 2026. Now, step 4 builds on that restriction. If the Fed cannot cut rates, then bond yields remain elevated or even increase. Right now, the 1-0-year U.S. Treasury yield is sitting around 4.39%, which means investors can earn that return annually with virtually no risk by holding government bonds. This is critical because it introduces a direct comparison between gold and bonds. That brings us to step 5, where the real pressure on gold begins. Gold does not generate any income. It doesn't pay interest or dividends. So when bond yields are high, the opportunity cost of holding gold increases significantly. Institutional investors who manage massive amounts of capital constantly evaluate where their money can earn the best return with the least risk. When they see a guaranteed yield of over 4% from government bonds, some of that capital naturally shifts away from gold and into bonds. At the same time, step 6 unfolds alongside this rotation. As global investors look for safety, they begin buying U.S. Treasury bonds, and to buy those bonds, they need U.S. dollars. This increased demand for dollar-based assets strengthens the U.S. dollar itself, and because gold is priced in dollars, a stronger dollar puts downward pressure on gold prices. When the dollar becomes more valuable, it takes fewer dollars to buy the same amount of gold, which mechanically lowers its price. So now you have three powerful forces hitting gold all at once. Higher bond yields making gold less attractive, capital rotating into bonds, and a stronger dollar pushing prices down. All of this is triggered by the same event that most people assume should be positive for gold, an oil-driven geopolitical crisis. This is why your gold is down, even while the world appears to be falling apart. And this is not unusual. This has happened consistently during every major oil shock over the last 50 years. But here's where things start to change. And this is the part most people miss completely. This suppression of gold prices is not permanent. It is temporary. And historically, it is always reversed. The pattern has played out so consistently that ignoring it could be one of the most costly mistakes an investor can make. If you go back to the 1970s, when OPEC restricted oil supply and prices surged dramatically, gold initially dropped before rising significantly over the following years. During that broader inflationary period, gold didn't just recover, it exploded upward by thousands of percent. A similar pattern appeared during the Iranian Revolution, when oil production collapsed and prices surged. Gold did not react immediately, but within a year, it rose sharply and continued climbing after that. The same dynamic repeated during the Gulf War, where initial reactions were mixed, but longer-term movements favored gold. After the events of 9/11, markets experienced extreme panic, yet gold began a long-term upward trend that lasted for years. Even more recently, when Russia invaded Ukraine, gold broke through major price levels and reached new highs. Each of these examples follows the same structure. The initial shock creates conditions that temporarily suppress gold, but once those pressures ease and the broader economic effects take hold, gold begins to move higher, often much higher. This isn't random, and it isn't based on sentiment alone. It is driven by the same underlying forces reversing direction over time. And when they reverse, they tend to do so together, creating a powerful upward movement. Now, what makes 2026 different and potentially far more significant than any previous cycle is not just the presence of conflict, but the conditions that already existed before the conflict began. Back in 1973, U.S. national debt was around $500 billion. Today, it has exceeded $39 trillion. That is not just a larger number. It represents an entirely different financial environment. At the same time, central banks are not selling gold like they were in the past. They are buying it aggressively at levels far above historical averages, signaling a shift in long-term strategy rather than short-term positioning. And then there is silver, which introduces an entirely different dimension to this cycle. Unlike in previous decades, silver is now deeply integrated into modern technology, from renewable energy systems to electric vehicles to advanced computing infrastructure. Demand is not just growing, it is becoming structurally embedded in industries that cannot easily replace it. At the same time, supply has not kept up, creating a sustained deficit that has lasted for multiple years. All of these factors combined create a situation where the current suppression of gold and silver prices is happening within a much more extreme structural backdrop than anything seen before, which means when the reversal happens, and history suggests that it will, the magnitude of that move could be far greater than what investors are currently expecting. Now, this is where everything starts to come together, because understanding the pattern is one thing, but knowing where we are inside that pattern is what actually determines your decisions. Over the years, I've seen this cycle unfold again and again, and every single time it follows a four-phase structure. It doesn't matter whether the crisis is driven by oil, war, or economic instability. The sequence remains remarkably consistent. And if you can recognize which phase we are currently in, you immediately gain an advantage over the majority of investors who are reacting emotionally instead of thinking structurally. The first phase is what I call the panic phase. This is usually the first few weeks after a major geopolitical shock. It's the moment when everything feels uncertain. Headlines are aggressive, markets are volatile, and emotions are running high. Oil prices spike sharply, gold often jumps at the very beginning, and then suddenly drops as the mechanical forces we discussed begin to take over. This is also the phase where financial media goes into overdrive, constantly pushing updates, dramatic visuals, and urgent narratives designed to keep your attention, but often increasing your anxiety. And during this phase, most retail investors fall into one of two traps. They either panic sell after seeing their positions drop, locking in losses, or they panic buy at the peak of the initial spike, chasing momentum at exactly the wrong time. Meanwhile, institutions are doing something very different. They are not reacting emotionally. They are watching, analyzing, and positioning quietly because they have seen this pattern play out before. Then comes phase two, which is the absorption phase, and this is where things get even more dangerous for the average investor. Typically lasting from the second to the third month after the initial shock, this phase is defined by a slowdown in panic but continued weakness in prices. Volatility starts to decrease slightly, the fear index begins to settle, and gold often pulls back further from its initial move. Silver, which tends to be more volatile, can drop even more aggressively, sometimes by 15 to 20% or more. And this is the exact moment where the majority of individual investors make their most expensive mistake. They look at their portfolios, they see consistent losses, they start questioning their original decision, and then they come across headlines suggesting that gold has failed as a safe haven. That combination of fear and doubt leads them to sell. And in my experience, after watching markets for over 4 decades, this is almost always the worst possible time to exit. Not because I can predict the future with certainty, but because historically, phase two has repeatedly marked the bottom of the cycle. Selling here doesn't just protect you from further losses, it ensures that you miss the recovery that follows. Now, phase three is where the real shift begins, and this is the phase that separates disciplined investors from reactive ones. This is the structural bid phase, typically unfolding between the fourth month and extending up to a year or more after the initial shock. By this point, the forced selling that dominated the earlier phases begins to fade. The panic is no longer driving decisions, and the institutions that stayed patient during the first two phases start increasing their exposure. Central banks continue buying, not based on short-term price movements, but on long-term strategy. Large investors begin reallocating into real assets, recognizing the structural conditions that support higher prices. Even retail investors slowly begin to re-enter the market, although often later than they should, once they feel more comfortable and confident again. During this phase, gold begins to stabilize and then gradually rise. But this time, it's not driven by panic or headlines. It's driven by structural demand, the kind that builds slowly but consistently. The same factors that created the earlier suppression, like high yields and a strong dollar, begin to lose strength. At the same time, underlying drivers like central bank accumulation, ongoing supply constraints, and long-term inflation pressures start becoming more visible. This is also the stage where related sectors begin to respond. Mining companies start benefiting from improving gold prices. Energy infrastructure becomes more valuable as oil disruptions are priced into the future, and the entire ecosystem surrounding commodities begins to strengthen. And yet, despite all of this, most retail investors are still sitting on the sidelines. They sold during phase two. They are now watching prices move higher, and they are waiting for a pullback that may never come. They tell themselves they'll get back in when there's a better opportunity, but that opportunity often disappears as the trend continues to build momentum. Finally, we reach phase four, which is where the full impact of the cycle becomes visible. This phase can begin around a year after the initial shock and may continue for several years. This is where gold reaches new all-time highs, not just briefly, but in a sustained and meaningful way. History shows this clearly. After the late 1970s oil crisis, gold reached record levels. After 9/11, gold entered a long-term bull market that lasted nearly a decade. Following more recent geopolitical events, gold has repeatedly broken through previous highs. And the reason this happens is not random. It is the result of the same forces reversing direction. The oil shock creates inflation. Inflation forces central banks into difficult positions, and eventually the pressure of managing massive debt makes it impossible to maintain restrictive policies indefinitely. At some point, interest rates begin to fall, the dollar weakens, and the very factors that once held gold back start pushing it higher. When that shift happens, it doesn't happen in isolation. All three major headwinds reverse at the same time, turning into tailwinds. Lower yields reduce the opportunity cost of holding gold. A weaker dollar increases its value in global terms, and renewed investment flows drive demand. That combination creates the kind of move that most people don't anticipate until it's already well underway. Now, based on everything we are seeing right now, the timeline of the current conflict and the behavior of the market, it appears that we are somewhere between phase 2 and phase 3. The panic-driven selling has already taken place. Much of the forced liquidation caused by margin pressures has already happened. And now, quietly, without much attention, the structural buyers are beginning to step in. Central banks are accumulating, long-term investors are positioning, and physical demand in regions like Asia is starting to increase again. Even when you look at forecasts from major institutions, the outlook reflects this transition. Some analysts have adjusted their short-term expectations slightly, but their long-term projections remain strong. Targets for gold prices continue to suggest significant upside, not because of speculation, but because of the underlying economic conditions that support it. This isn't about hype. It's about the structure of the global financial system and how it responds under pressure. But now we need to talk about something even more important, something that most investors overlook completely, and that is the role of silver in this entire cycle. Because while gold tends to lead, silver behaves differently, and in many cases, it becomes the more powerful mover once the cycle fully develops. Historically, silver often lags behind gold in the early stages. It doesn't react as quickly to initial shocks, and it may even underperform during the early recovery. But when it does move, it tends to move with much greater intensity. This creates a dynamic relationship between gold and silver, where the ratio between their prices expands and contracts over time. In previous cycles, this has led to situations where silver not only catches up to gold, but significantly outperforms it. For example, during the late 1970s, while gold experienced strong gains, silver's increase was far more dramatic, multiplying several times over in a relatively short period. The reason behind this difference lies in silver's dual nature. Unlike gold, which is primarily a monetary asset, silver is both a monetary metal and an industrial resource. In the early stages of a crisis, the monetary aspect dominates, which is why gold leads. But as the effects of the crisis begin to spread through the broader economy, silver's industrial demand becomes a second driving force. And this is where things become especially interesting in the current cycle. Because today, that industrial demand is not just significant, it is deeply embedded in some of the most critical sectors of the global economy. From renewable energy systems like solar panels to electric vehicles, from advanced computing infrastructure to defense technology, silver is essential. And unlike many other materials, it is not easily replaceable without compromising performance. At the same time, supply is not keeping up with this growing demand. The silver market has been experiencing consistent deficits where consumption exceeds production year after year. And because much of silver production comes as a byproduct of mining other metals, increasing supply is not as simple as responding to higher prices. This creates a structural imbalance that continues to build over time. So when the monetary demand for silver returns, which historically happens during phase 3, it doesn't replace industrial demand, it adds to it. And that combination is what has historically driven some of the most powerful moves in the silver market. And this is exactly where the opportunity becomes clear. Because when you combine a returning monetary bid with already elevated industrial demand and a constrained supply environment, you create conditions that are not just favorable, but explosive. This is why silver has historically shown a pattern of lagging behind gold early in the cycle and then accelerating rapidly once momentum builds. It's not random behavior. It's the result of two powerful forces aligning at the same time. And in 2026, that alignment is stronger than anything we've seen before. Think about the scale of demand alone. Solar energy systems require silver as a key conductive material, and that demand continues to grow regardless of price fluctuations because silver represents only a small fraction of the total cost of installation. Electric vehicles require significantly more silver than traditional vehicles, and as global production of EVs increases, so does the demand for silver. Add to that the expansion of AI data centers, advanced electronics, satellite communication systems, and defense technologies, and you start to see how deeply embedded silver has become in modern infrastructure. This is not optional demand, it is essential demand. Now combine that with the supply side. The market has been running a deficit for multiple consecutive years, meaning more silver is being consumed than produced. Inventories are being drawn down, and there is no immediate solution to increase supply because most silver production is tied to the mining of other metals like copper and zinc. This means even if prices rise, production cannot quickly adjust to meet demand. On top of that, geopolitical factors add another layer of constraint. Countries with significant control over refining capacity are beginning to treat silver as a strategic resource, limiting exports and prioritizing domestic use. So when the cycle shifts fully into phase 3 and the monetary demand returns, silver doesn't just follow gold. It gains an additional push from industrial demand that has been building in the background the entire time. This is what creates the kind of moves that catch most investors off guard. By the time the trend becomes obvious, a significant portion of the move has already happened. Now, if you want to understand when this shift is truly underway, you need to focus on indicators that actually reflect the underlying mechanics, not the headlines, not the daily news cycle, and not the emotional narratives pushed by financial media. There are two key signals that matter more than anything else right now. The first is the strength of the US dollar. During the initial phase of the crisis, demand for dollar-based assets increases, pushing the dollar higher and creating downward pressure on gold. Right now, the dollar index remains elevated due to this effect. But once the situation begins to stabilize, once alternative supply routes reduce the pressure on energy markets and the urgency for dollar liquidity declines, the dollar will begin to weaken. And when that happens, one of the major forces suppressing gold prices will start to fade. The second indicator is the yield on US Treasury bonds, particularly the 1-0-year yield. As long as yields remain high, the opportunity cost of holding gold continues to act as a headwind. But this cannot continue indefinitely, especially in an environment where debt levels are extremely high. At some point, the cost of maintaining high interest rates becomes unsustainable and policy shifts become necessary. When yields begin to decline, it signals that the balance is changing and that capital will start flowing back into assets like gold. These two indicators, the dollar and bond yields, tell you far more about the direction of gold than any headline ever will. When both begin to move lower, it signals that the mechanical suppression phase is ending and that the conditions for a sustained upward move are falling into place. Everything else, the news coverage, the daily fluctuations, the emotional reactions, is just noise. And when you look at what major financial institutions are saying, you start to see a consistent narrative. Price targets for gold are being revised higher, not based on short-term speculation, but based on structural analysis of global debt, central bank behavior, and long-term monetary trends. These institutions manage massive amounts of capital, and their projections reflect detailed research into the same mechanisms we've been discussing. They are not expecting the current conditions to last forever. They are anticipating a shift. So at this point, there are essentially two types of investors watching all of this unfold. The first type looks at the current price of gold, sees that it has declined from recent highs, and assumes that the opportunity is gone. They sell during the downturn, convinced that the trend has ended. And then, when prices begin to rise again, they look back and realize they exited at the worst possible moment. The second type of investor looks at the exact same situation but interprets it differently. They recognize the phase of the cycle, they understand the temporary nature of the current pressure, and they see the broader structural setup that remains intact. Instead of reacting emotionally, they act strategically. They accumulate gradually, without chasing prices, without panic, and without being distracted by short-term volatility. Over the past 40 years, I've seen both types of investors go through multiple cycles, and the outcome has always been consistent. One group builds wealth by understanding patterns and staying patient, while the other group watches opportunities pass by because they react too quickly or too late. And this brings us back to the idea of the unthinkable. Not because what's coming has never happened before, but because most people fail to recognize it while it's developing. Every major oil shock over the past 50 years has been followed by a significant move in gold and silver. That pattern has not changed. What has changed are the conditions surrounding it. Higher levels of debt, stronger and more consistent central bank demand, deeper supply constraints in silver, and greater reliance on metals and critical industries. All of these factors amplify what typically happens in this cycle. They don't eliminate the pattern, they intensify it, which means the move that follows could be larger, faster, and more impactful than anything we've seen in previous decades. So instead of focusing on the noise, instead of reacting to every headline, focus on the structure. Watch the dollar, watch bond yields, understand the phase we are in, and most importantly, don't let a temporary downturn in phase two cause you to miss what could be the most significant move of the entire cycle. Because by the time it becomes obvious to everyone, by the time headlines shift from doubt to certainty, the majority of the opportunity will already be gone. And the only question left will be whether you were positioned early enough to benefit from it.